And we're back. So let's begin doing the calculations on how to record what's known as depreciation expense using those different methods for depreciation. So we have a van that was purchased by Dryden Enterprise. The van has a list price of $23,500. We obtained a 10% cash discount from the list price. The van was delivered FOB shipping point, and we paid $250 for delivery. That's the transportation cost. We also paid $2,600 for a custom accessory package. So first ask yourself what cost should be included for this asset account. Well, it'd be the list price minus the 10% cash discount plus the transportation cost and the cost of customization. Therefore, the total cost for this van is $24,000. Okay? So we're going to take a look at that method, but first, we need some money. So let's assume that this transaction took place first. We acquired $25,000 in cash by issuing common stock. So when we did that, your cash account increased 25,000, common stock increased 25,000. On the statement of cash flow, that 25,000 would be an inflow as a financing activity. Okay? Now that we have money to buy that van at a cost of $24,000. So we bought the van. Our cash account decreased by, that. When we bought the van, go back. Our cash account decreased by $24,000, and our van account, which is an asset, increased by $24,000. Because you're spending money on statement of cash flow, you will see an outflow of $24,000 under your investing activities. Now, the van was rented to our customers for the year, and we earned revenue of $8,000 in cash. We're going to earn $8,000 each year. So our cash account will increase by $8,000. Retained earnings will increase by $8,000 because your revenue increased by $8,000. Statement of cash flow, there's an $8,000 increase as an operating activity. So notice that we're recognizing revenue from the use of this van, but the accounting rule says that if you recognize revenue, also determine any expenses that have incurred in the revenue recognition process. Meaning that we're now going to focus on what's known as depreciation, and we have a form what's called straight line depreciation. The formula is the cost of the asset minus salvage value divided by the asset's useful life to get the amount of depreciation expense. This asset costs us $24,000. It has a salvage value of $4,000, meaning at the end of 4 years, we estimate the van can be sold for an amount of $4,000. We plan to use the van for 4 years in order to earn revenue. Therefore, we're going to expense or depreciate $5,000 of the asset's cost per year. Okay? So we record depreciation. We'll talk about there's an account called accumulated depreciation, which is a contra asset account. So total assets are going to decrease by $5,000. Retained earnings will decrease by $5,000 because your expenses are going to increase by $5,000. So remember in the previous slide, we showed $8,000 by earning revenue, but now the expense amount would be $5,000 for recording depreciation on this asset. Okay? So at the end of year one, So each of your long-term tangible assets, like equipment, machinery, automobiles, they have a contra asset account called accumulated depreciation. This account is used to keep track of what portion of the asset's cost has been depreciated so far. Okay? There's something called book value, a term that you've heard of before. You may have think about your car and Kelly Blue Book value. Well, the book value is the original cost of an asset minus any accumulated depreciation. Again, it's the original cost of the asset minus any accumulated depreciation. Book value is sometimes known as the carrying value. So for our illustration, at the end of year one, the van has a book value of 19,000. The original cost was 24,000. We've expensed so far 5,000. So therefore, the van has a current book value of $19,000. So we said on paper at the end of year one, this van has a value of $19,000. Okay? So now, because it's straight line, we're going to expense the same amount every year, 5,000. We're earning revenue every year in the amount of 8,000. Notice that the van, the original cost is 24,000. That doesn't change. But what does change is the contra account called accumulated depreciation. That account is going to increase by 5,000 each year over a 4-year period. Okay, so these are the presentations on the financial statements for recording the expense for this van over that 4-year period. Okay, on the statement of cash flows, remember we're receiving 8,000 cash each year, but the actual cash outflow took place in year one when we spent 24,000 to purchase the actual vehicle. Also in year one, we issue shares of common stock. So there's an inflow of 25,000 in cash from the issuance of common stock, and you can see your ending cash balance at the end of each of those 4 years. Okay, now I need some water. Excuse me. All right, let's look next at the next method called the double declining balance approach. With this method, it is accelerated, meaning that we're going to expense a large amount in the asset's early years and a smaller amount as the asset becomes older. The logic is this: when an asset is newer, perhaps it's been used more, earning more revenue. As an asset becomes older, it's been used less, generating less revenue, therefore expense a greater amount in the asset's earlier years and a lesser amount as the asset becomes older. This is also called an accelerated method because, again, you're going to expense a greater amount in the asset's earlier years and a smaller amount as the asset becomes older. Okay? So now you need to know these 3 steps for this approach. So if you need to stop the video, write down these 3 steps. Step number 1 is determine the straight line rate of depreciation. To get that rate, you're going to take the number 1 divided by the asset's useful life. So if an asset has a 4-year useful life, 1 divided by 4 would give you 0.25 or 25%. If the useful life, say, was 5 years, it'd be 1 divided by 5, which would be 0.20 or 20%. So again, so first take 1 and divide that by the asset's useful life to get the straight line rate of depreciation. Now, because this is accelerated, we are going to, in step 2, double the straight line rate of depreciation. Therefore, if the straight line rate is 25%, take it times 2, we're going to expense 50% of the asset's beginning book value each year. So again, step 2 is to double the straight line rate of depreciation. To do the actual calculation, we'll take the asset's beginning book value. So beginning book value is going to be the original cost of the asset less any accumulated depreciation. So you're going to multiply the double declining balance rate times the asset's beginning book value each year. So let's take our problem and get into the actual calculation. So remember, this van had a cost of $24,000. So that $24,000 represents book value at the beginning of year one. Our straight line rate depreciation was 25%. So we doubled that. Our rate would be 50%. So you multiply 24,000 times 50%. We're going to expense $12,000 in year one. I get to expense $12,000 in year one. Now for year two, your beginning book value is going to be $12,000 because book value is original cost less accumulated depreciation. Remember, you expense $12,000 in year one, so for year two, beginning book value is $12,000. That is the original cost minus the accumulated depreciation. So for year two, we'll multiply 12,000 times 50%, and we're going to expend $6,000 in year two. So notice that the amount is going to be less in year two than it was in year one because this is an accelerated method. Now, keep track. So far at the end of year one and two, you've expensed a total of $18,000. Remember, this asset has a depreciable cost of $20,000. The depreciable cost is the original cost of $24,000 minus the salvage value of $4,000. You cannot go beyond the depreciable cost of the asset. So in year three, if I use the formula, you would take 24,000 minus 18,000, which is 6,000 times 50%, and that would give you 3,000 as the expense. However, if I add 12 plus 6 plus 3, that would give me a total of 21,000, right? Your depreciable cost is 20,000. And again, you cannot go beyond an asset depreciable cost. So therefore, in year three, we can only expense 2,000, which is the amount of expense remaining when it comes to this van. Okay? So now at the end of year three, this asset is fully depreciated. Therefore, in year four for this van, you're not going to recognize any depreciation expense. Okay, so here we see the statement presentation on the double declining balance method. Here you're seeing the expense amount being recognized each year. Here you see on the balance sheet the accumulated count is going to increase each year until you get to the 20,000, which are the depreciable costs. And once again, you cannot go beyond the depreciable cost of an asset. So at the end of year three, it is fully depreciated. So you see the same amount for the contra account in year four as it was in year three because you cannot add on any more depreciation expense. Okay? Statement of cash flows. This is showing the actual cash that came in. This is showing the purchase price. This is showing the issue of stock. So this is showing the cash inflows and outflows pertaining to the purchase of the van as well as the revenue received from the actual rental of the delivery van. Okay? So next we're going to cover our third and final method called the units of production. So you ready? You are? Okay, stay tuned for our next video lecture.